We're at CPM Specialty and Platinum Group Metals reception here during the PDAC in Toronto. Jeffrey Christian, Managing Director of CPM Group, joins me now. Jeff, thanks so much for being with me.
Thank you for having me here.
So Jeff, we're at the PDAC 2013 here in Toronto. Right. How has it been for you so far?
It's actually been a really good conference for us. I'm surprised. I mean, people are more upbeat on the metals outlooks than we had expected to find. But, you know, that said, the mining industry and the mining finance industry are constrained, and that's opening up a lot of opportunities for CPM Group.
Jeff, do you think that's a good sign or people are disillusioned?
There are some people who are disillusioned. One of the key things which I haven't gotten a handle on is the extent to which investors are disillusioned. I haven't seen the final numbers for registrations, but I think that there is a realization that even though prices are down and share prices are down and it's difficult to raise money for these junior exploration companies, that nonetheless the overall tone for commodity markets over the next several years is probably still sideways to higher.
All right, Jeff, let's talk physical gold right now. Offline, we were having an interesting conversation about what's happening in Turkey. What are some trends you're seeing there in relation to gold?
Well, the key thing, and it's very important both on a monetary basis and in terms of gold, is in September of 2011, when Athens was burning and the European leaders were fiddling and the U.S. government couldn't get its debt house in order, and then it had its credit rating downgraded. There was a tremendous amount of gold and foreign exchange that flowed into Turkey out of fear of what was going on in Europe. And the Turkish Central Bank created what they called the reserve option mechanism, allowing commercial banks within Turkey to meet up to 10% of their reserve requirements with gold.
Okay.
So you have physical gold that was ultimately, it was owned by the commercial banks that had a liability to return it to the private sector depositors, using that as to meet their reserve requirements with the bank. And you saw about 2.5 million ounces of gold show up on the reserves balance sheet in the fourth quarter of 2011. In early 2012, they raised it to 30% of the reserve requirement, and you saw another 5.3 million. So about 7.8 million ounces of gold has shown up on the Turkish Central Bank's monetary balance sheet as gold. And what it's not gold that they've purchased.
Okay.
It's really private sector gold. And to say that this is an addition to central bank gold is to overstate how much gold central banks actually have been adding. So that's a cautionary tale on the gold side. But on the monetary side, this is pure genius. And we think that it will be emulated by other governments and other central banks. And we also think that it could be a major move forward toward what a lot of central banks would like to see, which is really a multipolar international currency regime in which the dollar is no longer the sole reserve, de facto reserve currency, but rather people would be allowed to own their assets in gold, any currency, okay, domestically in the banks.
So break it down for us, Jeff. What could that do to the price of gold?
Well, what it'll do is it'll help support the price of gold. It wouldn't necessarily raise the price of gold because no one's going to go off and buy gold because of this. But we've been writing for several years, probably close to a decade now, about gold's renaissance and the rehabilitation of gold as a monetary asset and a financial asset. And this is potentially a really big step forward in the rehabilitation of gold as a monetary reserve asset.
Wow, okay. So that's a big statement, Jeff.
It's a really big statement.
Okay, well, I know Turkey has emerged in the past decade as one of the top central bank buyers of gold. Russia's number one position right now, right, then China, then Turkey. But so you're saying those numbers might not be exact?
Well, Russia's buying gold from domestic refiners. China, Kazakhstan, the Philippines, Venezuela, all are buying gold from domestic refiners. In Turkey, the government, the central bank, at least over the last 2 years, has not bought any gold. What they've done is they've allowed commercial banks to use gold on deposit at the commercial banks to meet their reserve requirements. Okay. And once they do that, it shows up as monetary gold on the central bank's balance sheet. So the Central Bank of Turkey actually hasn't bought any gold. It's just allowing the commercial and private sector within Turkey to mobilize that gold as part of the banking system.
So Jeff, that said, you're saying this is supportive of gold prices. Last time we spoke, which was a few weeks back, you're a bit more bearish. Has your tune changed?
Not really. I mean, we still think that the price of gold is going to move sideways to lower over the next 2 or 3 years. But what we've been saying all along is that we didn't see the gold price falling sharply. And we think that it could, we don't see it falling below, say, 1540 or maybe 1480 this year. But we don't think it'll fall below 1,400 over the next several years. And this is one of those things that we've been plugging into our model that tells us that the price is probably fairly supported at 1,400 or thereabouts, as opposed to if you look at other fundamentals, for example, the rise of mine production on a global basis, which is rising sharply this year and next year, and the backing away from gold investment demand on a marginal basis by investors. Those things you could look at and say, oh, gold prices could spike down, $1,000, some people are talking about. We don't see it spiking down to $1,000 because we think there are a variety of things supporting the gold price, one of which is this move to rehabilitate gold on a financial and monetary basis.
So, Jeff, you mentioned mine production, and yes, that's there, but what about the issue of the dwindling new discoveries lacking in gold? Won't that play a factor into the price?
Well, it is playing some factor in it. But the fact of the matter is that even with the dwindling of big discoveries, there is still a tremendous amount of gold that is known to exist in reserves and resources. And what we've seen over the last 10 to 12 years of the bull market in gold prices is that there have been a variety of human-made constraints to get those gold mines developed. But after 10 years of struggling, some of these mines are now coming to fruition. On a longer-term basis, you could see some decline. We're not a peak gold theorist any more than we're a peak oil theorist or a peak copper theorist. And the fact of the matter is there is a tremendous amount of gold out there left to be mined.
Okay, and Jeffrey, finally, before I let you go, just want to get some thoughts from you on this topic that's obviously trending right now, this issue of whether we're in a currency war or not, and how that could impact the price of gold with the devaluation of the yen and eventually the demise of the US dollar, as many believe. What are your thoughts on this?
There's really not a currency war. What you're seeing is a natural development in the current economic situation on a global basis of investors really having a tough time choosing which currency to back. And so you're seeing a valuation model. I don't think it's being driven by central banks or even government policy so much as it's being driven by confusion on the part of large institutional investors saying, which currency do I park my money in?
All right, Jeff, on that note, I'll let you get back to your party. Thank you so much for your thoughts.
It's always a pleasure.